Welcome to the deep dive. Glad you could join us. Today we're digging into something pretty interesting. How does a company like Coca-Cola, a giant, pull off strong financial growth even when their actual sales volume takes a dip?
It's a great question. It really gets to the heart of, well, corporate agility strategy, especially in the world we're in now.
Exactly. So that's our focus.
Yep, we're diving into Coca-Cola's second quarter 2025 earnings. We've got the earnings call transcript, the official news release. So we're aiming for that full holistic picture for you, showing how they navigate, all this complexity.
Right. And our mission here is to pull out the key insights. We want you to understand how this huge beverage company innovates, manages its growth, especially with everything changing constantly. We'll unpack the strategy behind what looks like, well, it's a contradiction. See what it really means. Okay, let's get into it. So the headline numbers. Q2 2025, net revenues up 1%. That's $12.5 billion. Organic revenues grew 5%. That's a bit stronger.
Right, stripping out currency effects and acquisitions.
Exactly. Operating income, this jumped out at me, up a huge 63%.
Yeah, that's massive.
And their comparable operating margin expanded too. 34.7% from 32.8%. So better core profitability.
Definitely.
EPS, earnings per share, grew 58% to $0.88. Comparable EPS, again, stripping out some items, up 4% to $0.87.
Okay.
But here's the twist. Unit case volume, actually down 1%.
Oh, yeah.
So strong financials, falling volume. How does that work? And what's this all-weather strategy and all the talk about pivoting plans?
Yeah, that's the crux of it, isn't it? The real story here is their agility. It's very proactive, very granular. This all-weather strategy isn't just marketing fluff. It's like baked into how they operate, maintaining growth no matter what.
Okay.
And the pivot talk, that's about speed, how fast they shift resources, marketing, you name it.
So give us an example.
Sure. Look at Q1 versus Q2. The U.S. and Europe were maybe a bit weaker in Q1, right?
Yeah.
They improved in Q2. But then, boom, new problems pop up.
Yeah.
Mexico, India, unexpected cold weather, a hurricane, even geopolitical stuff.
What?
So they constantly have to react, adapt, execute fast just to keep growth on track. It's like a core skill they've built.
So it's less about avoiding problems and more about reacting really well.
Exactly. And despite that volume dip, remember this, they gained value share in total non-alcoholic ready-to-drink stuff for the 17th quarter in a row.
17. That's quite a run.
It is. And it shows they're really focused on value, maybe more than just pure volume right now, through pricing premium products.
Okay, 17 straight quarters. Impressive.
Yeah.
But does that value share gain translate straight to profit, or, does it cost a lot to keep that share, like heavy discounts or marketing?
That's a key point.
And how does this all play out regionally? It must be incredibly complex managing local realities for a company this size.
It is complex, but the results suggest they're managing the cost side too. Those expanding margins. They indicate they're not just sort of buying share inefficiently. And you're spot on. The regional breakdown is where you really see their agility tested. Let's walk through it.
Yep.
North America. Volume down? Yes, but better than Q1. Sequentially improved.
Right.
And that improvement comes from strategic investments.
Right.
Think Coca-Cola Zero Sugar, Diet Coke, also Fairlife, Body Armor, those wellness drinks. They also mentioned good traction with food service. And remember that Hispanic consumer issue from Q1?
Vaguely.
They said it was largely resolved by June. Very targeted ads, really pushing Coca-Cola's localness in the U.S.
Yep.
Made here, distributed here.
Interesting tactical move. Okay, what about LATAM?
Latin America. Similar picture in one way.
Yeah.
Volume declined.
Yeah.
But organic revenue and profit up.
Ah, okay.
Argentina's improving economy gave them a boost. Coke Zero Sugar did well in Brazil and Mexico. Mexico, though, got hit hard. Unusually cold weather, then a major hurricane in June really impacted things.
Oof. So how did they pivot there?
Quickly. Reprioritized investments, pushed affordability with refillables, but also premium single-serve options, scaled up digital ordering too.
A bit of everything then. What about across the pond? EMEA?
EME, Europe, Middle East, and Africa. Now, this was a genuine bright spot. All three parts, Europe, Eurasia, and Middle East, Africa grew volume, revenue, and profit.
All three? Nice.
Yeah. Europe saw volume growth pretty broadly, East and West. Help out an easier comparison last year, partly. Coke Zero Sugar, Sprite, Fuse Tea grew. And they activated that Share a Coke campaign again, but revamped. Across 38 markets, used musicians, influencers, some digital tools for personalization.
Bringing back a classic.
Exactly. Eurasia and Middle East. They grew volume and value share even with multiple conflicts in the region. Big emphasis again on localness, local sourcing, production, jobs.
That seems like a recurring theme.
It is. Focused on local flavors, affordable pricing, value packs. Africa also drew volume, which is impressive given the worsening macro picture there. Egypt, Morocco, Nigeria showed strong momentum. Their actions, refining pack prices, fewer but bolder marketing campaigns, getting more cold drink coolers out there, really disciplined execution.
So EMEA sounds like a success story in adapting locally. Asia Pacific, you said mixed bag earlier.
Yeah, Asia Pacific was more varied. Overall volume dipped, but revenue and comparable currency-neutral operating income grew.
Okay, so value again.
Right. ASEAN and South Pacific, volume declined overall. Australia and the Philippines grew, but Thailand, Indonesia, Vietnam were down. Still, they gained value share. They scaled up refillables, increased store coverage, more coolers.
Standard playbook, sounds like.
Pretty much. China grew volume, which is good considering the cautious consumer there. Trademark Coke and the eating-drinking channel led the way.
Yay.
Strategy was more granular execution, tailored promotions, more cools again.
In India, you mentioned headwinds there.
India, yeah, tough quarter there. Started strong, but then early monsoons and geopolitical issues hit during the key summer season. Volume declined.
So pivot time again.
You got it.
Yeah.
Integrated marketing campaigns. Coca-Cola meals linking Thumbs Up with biryani, Sprite, Mazza with festivals. Very tailored locally. They also hit over 1 million customers on their digital ordering platform and refranchise bottling in southern India to bring in new energy.
Okay. And Japan, South Korea.
Japan and South Korea. The whole industry saw volume decline there. Challenging macro environment. Coke's volume was down too, reflecting that, and a tough comparison to last year. But their 2-year trend was still positive. So they're focused on refining channel strategies, finding growth pockets.
Wow. Okay, that's a whirlwind tour. It really paints a picture of constant, localized adjustments. That regional complexity makes that original puzzle growth, despite volume dips, make a lot more sense. It really drives home that even for a global giant, it's about ground-level execution. But zooming out again, what are the sort of bigger strategic pillars holding this all up beyond just the regional plays?
Absolutely. It's definitely multifaceted. There are some clear strategic pillars that enable that agility we keep talking about.
Like what?
Well, first, marketing transformation. This isn't just about ads. It's a core capability. Lets them test ideas fast, share what works, scale campaigns globally, but tailor them locally.
So like a learning engine.
Exactly. Remember Mexico? They used tactics developed in Turkey last year. Tailored them. Pulled forward World Cup stuff. It significantly improved their value share trends and how consumers saw the brand there.
Smart. Cross-pollination of ideas.
Then you have big campaigns like the Share a Coke relaunch. Global, revamped over 120 countries, billions of bottles. That directly helped single-serve transaction growth. And in North America, Diet Coke's This Is My Taste campaign, inspired by social media chatter about its crispy taste. That helped Diet Coke get its 4th straight quarter of volume growth there.
So tapping into consumer language.
Precisely. Then there's their innovation agenda, really focused on anticipating what consumers want.
Examples.
Sprite plus tea in North America started small, an experiment. But consumers liked it, social media buzzed, so they scaled it up, helped Sprite become the #3 sparkling brand in the U.S.
Interesting. From experiment to mainstream.
Yeah. And they're expanding Coca-Cola with U.S. cane sugar this fall, responding to interest in different experiences. Plus, they mentioned experimenting with fiber, like Coke with fiber in Japan. Always gathering learnings.
Okay, marketing, innovation. What else?
Revenue growth management, RGM. This is huge for them. It's how they slice and dice consumers, channels, figure out the right product, price, pack size for each. It leans tightly with marketing.
How does that play out?
Well, they added over 130 million transactions just in juice drinks this year. How? By focusing on lower-cost single serves in places like Latin America and India. Or in Spain, they introduced an affordable 1.25-liter bottle, improved the shelf display, volume went up. Small tweaks, big impact.
Driving value through smart packaging and pricing.
Exactly. And that ties into refillables and premiumization. They're using their LAHAM expertise to grow refillables in Africa and Asia. At the same time, using North American know-how to push mini cans in Europe.
Borrowing best practices across regions.
Right. They're also using tech, an AI-based pack price channel optimization tool, piloted in Mexico, now in 8 markets. Helps them refine offerings, get to market faster.
AI in the mix too.
Yep. And underpinning it all is robust local execution. They kept stressing their bottling system is stronger than ever, learning from each other, committed to investing more.
That's a comprehensive picture. It's definitely not just about the drink itself, but this whole ecosystem of marketing, innovation, pricing, execution. It sounds like most of these strategies really landed well this quarter. Were there any experiments or innovations that maybe didn't quite hit the mark? What did they learn from those?
That's a good question. The call definitely highlighted the wins, as you'd expect. But one area they did sort of touch on with a bit more nuance was coffee.
Ah, right, coffee.
But before we zero in on coffee and Fairlife capacity, let's quickly cover the main financial takeaways and the outlook they gave. John Murphy, the CFO, laid that out.
Okay, financials and outlook.
Right. So repeating the key numbers, 5% organic revenue growth, but that 1% unit case decline mostly blamed on a weaker June. Price mix grew 6%. That's crucial. It means they're getting more revenue per case sold, either through higher prices or selling more premium stuff.
Making each sale count more.
Exactly. Comparable gross margin up 80 basis points, comparable operating margin up 190 basis points, partly productivity gains kicking in.
Efficiency helping the bottom line.
Definitely. Comparable EPS up 4% to $0.87, even with a 5% currency headwind eating into it. Free cash flow looks strong, too. Excluding a specific payment for Fairlife, it was $3.9 billion. That's up about $600 million year over year. Shows the underlying business is generating cash.
Solid cash generation.
Yeah. And they made their final big U.S. tax payment related to the 2017 changes. Balance sheet remains strong. Debt levels are good. Now, Fairlife, still growing strong, double digits in Q2 volume, but it did moderate a bit.
Okay.
And they expect growth to slow more in the second half. But, and this is key, they stress it's because of capacity constraints, not weaker demand or competition.
They just can't make enough, right?
Basically, yeah. But the new facility in New York, coming online early 2026, that should fix the bottleneck over time for all the Fairlife products. And interestingly, they mentioned Santa Clara in Mexico is now the #1 value-added dairy brand there. So the model works elsewhere. They're looking at international protein opportunities, too.
So Fairlife's hitting capacity. Is that a missed opportunity now, or are they just playing the long game by building the new plant?
Oh, definitely the long game. They're building for sustainable growth, not just pushing beyond limits now and risking quality or supply issues. Sensible. Now, about coffee category participation, they were quite open, acknowledged it's huge, growing, but fragmented.
Right, lots of players.
They talked about Costa being their fourth try at coffee, Georgia, Keurig, even Dunkin' Coffee, way back in the 60s were previous attempts.
Fourth time's the charm.
Well, they admitted the Costa investment hasn't quite delivered across all the different avenues, stores, ready to drink, machines as much as they'd hoped. Still quite store-heavy. The language used was revealing, reflecting on what we've learned, looking for new avenues to grow. Doesn't sound like a runaway success yet.
Given that history, do they need to win in coffee? Or maybe focus those resources elsewhere?
That's probably the internal debate, right? Coffee's tempting huge market, but it's tough to crack. Needs specific focus. Their comments suggest they're seriously evaluating if the current Costa approach is the best path forward.
Okay, something to watch there. What else on the financial front?
Well, a positive note. Productivity savings came in better than expected in the first half. Marketing transformation, tight cost control.
Good news.
Yeah, because it gives them more optionality, as they put it, more flexibility to reinvest in the second half, build momentum into 2026.
Smart. Using savings to fuel future growth.
Exactly. So their updated 2025 guidance, they're sticking with 5% to 6% organic revenue growth for the year. But they bumped up the comparable currency-neutral EPS growth forecast. Now expect around 8%.
Okay. Higher profit growth expectation adjusted for currency.
Right. Overall comparable EPS growth, including currency hits, is now seen around 3% compared to last year's $2.88. Currency headwinds are still expected, about 1–2% on revenue, 5% on EPS for the full year. That's despite some recent favorable moves, but they're largely hedged. Free cash flow projection, excluding that Fairlife payment, stays at about $9.5 billion.
Okay, solid outlook overall, slightly better underlying profit growth. Any flags for Q3?
A few things to keep in mind for Q3. They expect concentrate sales might lag behind unit cases slightly. Recovery in some of those hit markets, like India, will take time. Impact of global trade stuff on cost, they think it'll be manageable. Margins are not expected to be back half weighted anymore because they expanded strongly earlier. And Q4 has an extra reporting day, just for planning.
Got it. Lots of moving parts. Well, this deep dive into Coca-Cola's Q2 has been really insightful. It absolutely highlights that strategic depth, that incredible agility they have in, well, a pretty messy global environment. You know, navigating everything from weather to geopolitics, but keeping that laser focus on local consumers, prioritizing value. It makes you appreciate the layers of decision making.
Given this relentless focus on local dynamics, affordability, anticipating what consumers want next, what could be the next surprising pivot or innovation we see from them? Something that maybe goes beyond just traditional drinks. Could they leverage that massive distribution network, that depth consumer connection, to tap into something even broader in our daily lives? What might that look like for a company that seems to constantly redefine itself? Something for you to think about until our next deep dive.